Good afternoon, ladies and gentlemen, and welcome to the MATTIOLI Woods PLC investor presentation relating to the interim results for the 6 months ended 30th of November 2020. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Simply type your question and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where appropriate to do so. These will be available via your Investor Meet Company dashboard. I'd also like to remind you that this presentation is being recorded. Before we begin, we'd like to submit the following poll. I would now like to hand you over to Ian Mattioli, MBE, CEO, and Ravi Tara, Group FD of MATTIOLI Woods. Good afternoon.
Thanks, Paul. It's quite complex because we sit here having, as a nation, as a world, really never gone through this position. It's certainly in anybody's living memory. You know, the world has gone through it before, of course. We're now 30 years old, and it's not a word that we ever dreamt of using 30 years ago, but it's the word disruptor. Back then, what MATTIOLI Woods did and was about was actually taking on the large, old-fashioned institutions. Those companies, I believe, maybe as they still are, were more concerned about their own profit and well-being than their clients. And in all our history, we've been concerned more about our clients' well-being and their profit. A lot of you today are hearing me speak for the first time, but very often I will say that the problem with success in financial services is that it creates greed. We've used every ounce of our strength and knowledge, our sinew, to make sure that our success actually breeds integrity. And just a few things, you know, about us over those 30 years, which will, you know, prove and show that's what we're about. 30 years ago, we were one of the first financial services businesses to charge fees. You know, that's quite common now, particularly with RDR. And we dealt with that commission versus fees 30 years ago. One of my original clients, who's still a client today, along with their family, I could have earned enough money from the commission to be generated from Keith's pension policy. It would have actually repaid my mortgage. What we chose to do was to charge a fee, and the fee at the time was £1,500. As I said, Keith is a client still today, but over the last 30 years, he's introduced us to about 40 of his friends, because ultimately he knew that we'd done the right thing by him. And his accountant introduced about another 100 clients. And that's the way you grow and develop a long-term sustainable business. You do the right thing all of the time. You look after the clients, and I believe the clients will then look after you. And you only have to see our growth to support that. 30 years ago, compliance also was at the core of what we do. And 30 years ago, you know, we weren't a strongly compliant financial services organization. But compliance was at our core. It was actually embedded, and still is embedded, in everything we do. It's not there to protect us from the regulators. It's there to ensure that our clients and their assets are as secure as possible. Throughout that 30 years, when I look back, the reason why we've grown is we shared our intellectual property. Basically, that's our knowledge. And we shared it with others. some outside of the organisation, and lots of it within the organisation. We trained and mentored, and that's really key, because when you train and mentor, you can create again a long-term sustainable business. Businesses that stand still, and sorry if I get on my high horse now, but businesses that stand still generally die, and we've particularly seen that in the last 2 or 3 years. The main aim of a business is not to die, so you have to do things in order to make sure you're still around. We want to be around in another 30 years because I'm still looking after Keith and Barbara. But not only are we looking after them, we're looking after their children and their children's children. And in some instances now, we're dealing already with 4 generations of the same family. That's why it's important to us that we train and mentor. If anybody's ever mentored anybody, and I've mentored a fair few people over my time, you're just about to take half an hour where actually it would just take yourself 5 minutes. But those businesses that don't train or mentor can't ever move forward, because you can't succeed the business to the next generation. We continue, as we've always done for 30 years, to keep sufficient monies within the business so that we can continue to invest. So many businesses during this early part of the pandemic started to do things that we would never do. They cut their marketing budget, they stopped recruitment, and worse still, a lot of people in financial services, although we're a key industry, put people on furlough. I have a saying which goes, there is an expectation from our clients that not only can we look after their money, but we also can look after our own. So, during the pandemic, I'm quite proud of the fact that we haven't used 1 penny of government money or intervention. When we come out of this, people's buying, I think, will change. One of the things I'm certainly going to do is look at how the company I'm just about to buy from, how it behaved during the pandemic. You know what? If it didn't behave well, and we know some companies haven't behaved well, then I'm simply not going to buy. And people are hopefully going to apply those rules across many industries. It's important that businesses don't stand still. We've seen in the retail market so many businesses in the last 3 or 4 years, pre-COVID, start to die, and that's because they haven't taken the complex decisions about who and what they're going to be in the future. A lot of them have become complacent. Complacency does not sit well at Mattioli Woods. In sitting still, we've seen some clients increase clients' pricing, asking clients during this period to pay more. That's the last thing a financial services business should be doing at the moment. It needs to empathise with its clients to make sure that it's fit for purpose and dealing with client outcomes, not just its own. As I've already said, some businesses have reduced capacity. If you reduce capacity, when the good times come, you can never be ready for it. And again, during this pandemic, we've employed 34 new people who we will continue to train and put through our programs. It was quite interesting. M&G were established the same year as my dad was born, 1931. It announced just the other week that it was creating a training academy for advisors. It's like we had our training academy 30 years ago because we knew we had to train people in order to be modern and break the mold of the old style of institutions. in essence, what we're doing is we're doing things right, and we're not having to put things right. I talk to so many chief executives who tell me all of their woes and the fact that they've spent the last 5 years trying to put right what should have already been put right. We're on the front foot. We're moving forward. We're growing. We're developing. The average age of an IFA consultant advisor in the UK is 58. You know, that's my age. You know, I've got grey hair these days. Our average age is 38. That's giving us capacity for growth and development in the future. I'm pretty convinced because our market has seen some sort of interesting moves. In the last few months, we've seen a lot of private equity style houses buy wealth management and advisory businesses. I've got no doubt if I stopped the training, the mentoring, the development, the investment in technology, if we stop that, our profits could be £2-3 million more if we chose to do that. But in 3 years' time, what would start to happen? We'd start to fall off a cliff because we wouldn't have made the necessary investment to be a modern 21st century financial services business. Our plan is really quite straightforward. You know, we want to grow because we're ambitious. And we want to grow sustainably so that we're here for another 30 years to look after Keith and Barbara and indeed their families. We need to honour the trust that people like Keith and Barbara have put into us. And now their families, of course. And we want to do that, not just for today. You know, again, so many businesses just invest for today. Well, in fact, it's not really an investment if it's for today, it's just a cost. They're just like surviving. What we're looking at doing is being here in that 30-year period. So the next 30 years is really about using and honing our skills, being even more expert than we are, building out our 5 core pillars of the business, which I'll expand when we start to move through the slides. You can leave that 5 pillars up because it's a good one to be looking at just as I finish off this initial part of the presentation. Our 5 pillars are all about growing and winning new clients. Winning new clients who we don't know today, tomorrow, is actually quite complex. Our 38-year-olds are able to go out there because they understand this technology much better than I do. You know, I can train and mentor them on how life is, but boy, oh boy, do they train and mentor me on how to use this technology. And that's really important. The private equity houses buying wealth management business gives us a further opportunity. It's actually unsettled some really good, professional, experienced advisors. It's unsettled them so much they're looking at a long-term sustainable home for themselves and ultimately their clients. And that's us. And we'll also grow by bringing in like-minded businesses and complementary businesses to the group. There's a word called acquisition, and that's a really harsh word for me. And you know, we do acquire businesses, and you know, our history shows us that we've acquired 26 over the last 15 years, all successfully. But we only acquire a business on day one. Thereafter, we blend and merge them. And that blending and merging is actually why we've been successful. We looked at a business just a few weeks, a couple of months ago, and we thought, yeah, it was an okay business, but it actually needed some real staffing. it needed about another 50 people. A private equity style house has bought that, and the first thing it did was laid 20 of them off. And we're thinking, well, it needs 50 more, not 20 less. Thankfully, our market space is huge. When Bob and I first came to market, we were very specialised in what's called small self-administered pension schemes. Our total client demographic at the time was about 100,000. So there'd be 100,000 privately owned businesses who were successful, who actually were able to have this thing called a small self-administered pension scheme. For the last 30 years, we've developed from that very specialised SaaS consultancy into SIP, into personal wealth management, into trusts, into employee benefits, in creating a dynamic wealth management platform. Our market might now be as high as 10, if not 12, 15 million people who could use the range of services that we have at this moment in time or will very shortly have. And that technology piece I'll come to later on in this presentation. So growth is key. What history tells me again is, in growing, stick to your knitting. Don't go off piste. Just stick to really what you know, but develop. In knitting terms, there's hundreds of patterns. Well, there's hundreds of patterns of how to grow and develop a wealth management business without going right side or left side field. A key element to who we are and what we do is we own our distribution. So through a team of consultants, advisors, we see clients face to face, screen to screen, directly. So the Keiths and Barbaras are actually known to us. It's not like we're dealing through a third party in order to attract those key client relationships. We know we've got to do a bit more. I'll come on to the 5 pillars in a second. We need to develop out those 5 pillars, and we also need to develop out our investment proposition, all of which we know we can do. 4 years ago, we hardly had any assets under discretionary fund management. We've now got the best part of 3 billion of assets under discretionary fund management. So, we're all about sort of growing and developing, but it's evolution, not revolution, and that's key. So just to finish off, I'm a great believer in putting goals into a business. A business without goals, is either complacent or not directed. When the business was started in my tastefully converted garage, our first goal was to have 100 clients. Well, we quickly surpassed that. As we sort of moved offices into formal premises, we started to employ people to train and grow. Our next ambition was to have £1 billion worth of assets under management. We broke that. We had an ambition in order to broaden the share ownership to float the business on publicly listed markets. We did that 15 years ago through our flotation on AIM. Let's not remember, when we floated on AIM, our revenues were about 7 million. They're just around 60 million as we speak. About 5 years ago, we put some big, hairy, audacious goals into market. This is at a time when our revenues were 17 million. Our profit margin was 20% plus. And at the time, we had 2.5 billion of assets under management. The new goals were we wanted to be a 100 million revenue business. We needed 15 billion of assets to do that. And we wanted to maintain the 20% plus profit margin. Where we are now, we're in grasping distance of that, so it only feels right and proper that we have new, big, hairy, audacious goals. That tells people who we are and indeed what we could be. It helps shareholders in particular focus on where our ambitions sit. It also helps clients because they know that we're still going to be here in 30 years. So, you know, the Keith and Barbaras are quite happy to refer their friends to us because they know we're going to do a good job long term in looking after their financial affairs. The new big, hairy, audacious goals are all about creating revenues of 300 million. We think we would need about 250 fee generators to do that, all bringing in about £1.25 million to give us 300 million of revenue. In wealth management terms, that's about 125 clients, and each client's having £1 million. Some of our top end consultants at the moment, their revenues are touching just under 2 million. So I know that is achievable as we grow and develop the capacity, which I'll run through later on in the presentation. We'd need about 30 billion of assets to do all of that. And we would need to capture and retain a TER, total expense ratio, of around 1%. But that's along all of our 5 pillars. So Ravi, if you could just flip me back one slide onto the 5 pillars. And I'm just going to spend a few minutes on this because this is really our USP. This creates our distribution, and it also creates the quality of earnings that we enjoy in both good times and indeed during the pandemic in bad times. So we're quite proud of the fact that, you know, we are an advisor. We're not frightened to give advice. Advice is necessary because, you know, if I take my position, you know, I've been in pensions for nearly 40 years. Last year, you know, I was lucky enough to be able to take my tax-free lump sum, having achieved the age of 55. And, you know, I thought, right, I shall do that. But, you know, I've got 3 different regimes, you know, lots of old schemes, new schemes. Actually going to an advisor and saying, you know what is the tax-free lump sum is very valid because it's really complex. So giving that advice is really key. There's no point in giving good advice and creating your own distribution if you then have to farm out your administration to somebody who can't do administration. You know, my personal background is that I'm an administrator. I understand the connectivity of doing one thing in line with another in order to achieve a satisfactory result. These days, it's no good being a good advisor and having a solid platform, giving solid administration if you've not got a platform to hold all those things on. 30 years ago, we created our platform internally. We call it MWeb. MWeb manages the best part of £9 billion worth of assets on behalf of our clients. It knows where every penny's been, where every penny is at the moment, and where every penny is going. It can pay out pensions, pay out lump sums, do the calculations like anybody else's platform can. We're also a pretty good investment manager. You know, we've not got Simon here today, our Chief Investment Officer, but, you know, his range of funds, you know, have been awarded 5 stars, 3 stars. And, you know, 3 years ago, we didn't really have a range of funds. So our range of funds, which are, you know, held within our bespoke discretionary portfolio service, is really key to see clients' assets be as secure as possible, but equally to enable them to grow. Anybody who's a good advisor, good administrator, good with platform, good with investment manager needs good product as well. A SAS and a SIP is a product for us. Our portfolio funds are products. Custodian REIT is a product for us. This is our structured products fund. Now, when we put all that together, this is responsible integration. So getting back to the big, hairy, audacious goals, we think we can be 300 million of revenue. We will need about 30 billion of assets, 250 people to bring in 1.25 million. And when we've done all the sums, what that produces is 100 million of profit. You know, one of the early questions is, you know, can we increase margin? Going from 20% to 30%, I would argue, is an increase in margin, but 30% is probably where we feel comfortable. If it starts to exceed 30%, as we have seen in some financial services businesses, you know, let's pass that back to the client, because looking after the client is everything in our business. And if we're making a 30% margin, you know, they need their TERs reducing a bit. And of course, TERs may be reduced within the industry because of legislation, not just competition. So moving on, you know, one of the, just flip back on. Yeah. Have we not got the, yeah, that's the one. It's okay having big, hairy, audacious goals, but what you have to do is prove how you're going to get there. And this is basically a simplified version of how we're going to get there. The top line says win new clients. So many businesses don't win new clients. What they mean by organic growth is doing a bit more with existing clients. A new client to us is somebody we don't know today. And we set our stall out through all our marketing, all our branding, in order to achieve that. We know we can accelerate growth through strategic acquisitions, which become businesses that we blend and merge in. But also we've got this, you know, the unsettled people who have been bought by private equity, maybe have had a bad series of events working for a business hasn't invested enough in itself. We're starting to win those people. We've won 2 in the last 6 months, and during that 6-month period, they've brought in 20 million pounds of new client money. That's brilliant for us. So that's how we're going to achieve the big, hairy, audacious goals. Win new clients. We are going to extend the acquisitions, and we're going to continue to develop the investment proposition, the technology, and simplify the administration. It all sounds easy. It's actually a bit harder in practice, as we all know. And that's why we need this great team, which we have behind us. I did a similar seminar to this one yesterday to all of our staff, really to show them our ambition and their career prospects, because a lot of people forget what career opportunities they have with us. You know, this is a 30-year career opportunity, and it's actually pleasing. A lot of our clients, you know, they steer their children to us, which is, for me, great. I'm going to pass you over now to Ravi. So we're just going to spin the camera around, and Ravi will start to talk through some of the numbers.
Yeah, absolutely. Thanks very much, Ian. And given that we are talking about the 6-month results, it does make sense to go through some of the highlights as we see them. So some of these facts you'd have seen or have heard from Ian already. But the first point to note, given it or bearing in mind our current medium-term ambitions, was that we broke through the 10 billion barrier of client assets. In fact, you'd argue that is close to 11 billion at 10.6. Which has been a credit in the month, in the 6 months. I think the other thing to note there is we've put it just underneath that text. We've achieved 10.6 billion of clients' assets, but that's despite having paid out 60 million pounds worth of funds to clients who've withdrawn benefits paid. Now, as a financial services business with our core and our centre based in pensions, that gives us the most satisfaction that clients that we've advised for a number of years have managed, based on the advice we've given, to extract some value and live the lives that they want in retirement. The next feature of the 6 months, and I'll talk about this in a bit more detail, was that revenue was slightly down at 29.5 million, as we had expected, and I'll go into some of the details of that in a second. But the thing to bear in mind is, as a business where our revenue model is based on time-costed fees rather than ad valorem fees based upon asset values, we have a high recurring revenue of around 94%, and building on that further, our time-costed fees make the majority of our revenue base at 54%, which distinguishes from others in the business who are somewhere around 90% ad valorem. Adjusted EBITDA increased in the period to 8.9%, an increase of 7%. And to the question that was raised earlier, our adjusted EBITDA margin is currently 30%, as it was in the year just gone to May. But we see both of those periods as slight anomalies or abnormal years based on a number of decisions that we took around staff bonus and some cost savings. And longer term, we'd expect that to trend down before we deliver some of the operational improvements to increase margin again. Again, adjusted PBT increased by 5% to 7 million. And as you've heard from Ian, our gross discretionary assets grew again in the period, some 700 million to in excess of 3 billion at 3.3. And that's all based on the core Mattioli Woods discretionary management proposition. Despite that, where we've seen revenue down and profits up, we've continued to invest in that capacity. We've continued to invest in the team and the areas that will build our potential and our growth for the future. We've invested in technology, and we're expecting to invest even more. We've invested in our compliance, and more importantly, we've invested in what you'd argue is the key asset of the business, our people. We've invested in new people, and for our existing base of more than 600 staff, we continue to spend money on training, and we take pleasure in that spend. From a financial stability perspective, we remain in a very strong position. At the end of the 6 months to November, we had a cash balance of 18 million. And we maintain a healthy surplus over our regulatory capital position as well. Talking about growth, we're very proud of the fact that we are strict in our acquisition pipeline, but 2 recent businesses that we acquired are performing well and in excess of where we expect them to be. The most recent acquisition, or merger as we call it, was the Hurley Partners, who in 4 months of the year to date have delivered over £2 million of revenue and over £700,000 of EBITDA. All of that means that adjusted earnings per share rose by 1% to 20.4 pence, and on the basis of our financial stability, our results, and where we expect to be for the rest of this year, we're pleased to confirm an increased interim dividend of 7.5%, which is a 3% growth on the same period last year, and maintains our position of having a progressive dividend policy. So if we move then into a bit more detail on the financials, or on the revenue in particular, I think a key feature of the last 6 months was the fact, number one, that it's the first reporting period that's been entirely in a COVID situation. If we look at the last year to May, that was part in what you'd call a normal world, and part in lockdown. But the 6 months we've seen just gone were entirely in that period. So the theme, or the word that we'd use to characterize those 6 months, would be uncertainty. Uncertainty for clients in terms of what life was, what it meant for them, what it meant from a health perspective, what it meant for their future. And then the next question was uncertainty around what it means for clients from their financial well-being and their financial position. So uncertainty, whilst it drives the demand for advice for us, it also means that, and we advise our clients in many cases to this, that clients adopted what label as a hold and wait mentality. So hold the position that they held and maintain that for the foreseeable until such time as that confidence returns. So as we look at revenue, you could say it is flat with a slight decrease, but there are a number of key features in that. In our core pensions and administration business, what we saw was that initial increase in advice in the springtime into the summer. Once that initial advice had been given, and we contacted every single one of our clients in those first 8 weeks to calm down the situation and give that advice, what we saw then was a transition into transactional activity. And in fact, what we saw was a reduction in transaction activity for things like property sales and purchases, for loan backs, and those types of specialist consultancy advice offerings that we have. We saw the demand for those decrease in that period. What we are now seeing, post-November, is a return to a demand for financial planning advice. So those transactions are already restarting, and we are seeing those requests come back. If we move on to our investment and asset management business, clearly I don't need to say, but at the start of the pandemic, we saw markets fall considerably. We saw 30% reductions overnight in asset values, and as we've come into this first half, in the first quarter we saw an improvement, and in the second half we saw continued improvement, and to date we see that trajectory continue. So a feature of the first 6 months was asset values were lower than they were in the same period last year, and consequently the ad valorem fees that we earn on those assets is marginally down. Within the revenue profile, you see that advisor fees are down as well, and a lot of that relates to our Private Investors Club. The Private Investor Club offers opportunities to those individuals who would be considered sophisticated or high net worth sophisticated individuals, investors, or high net worth individuals. And based upon the uncertainty that's in the market, these syndicate opportunities, whilst they do offer higher returns, also come with increased risk. So we took a decision based upon the macroeconomic situation that would pause those investments. So in the period just gone, in the 6 months just gone, what we saw was one opportunity to come to bear, and we invested 2.5 million in that syndicate. The same period in 2019, we had 7 opportunities that we launched, and we'd invested just under 17 million. So clearly that our revenue on that would be reduced. Some of the positives that we do see are our employee benefits business, which isn't necessarily linked to macro markets or the asset values, and we saw an increase in revenue based on new client wins, and we continue to see those beyond November. But the more pleasing thing is that last block, where we talked about merging with other businesses. We're very strict in our criteria, and that points to the fact that the businesses that we do bring on board are quality businesses. We had Hurley Partners who delivered slightly over 2 million worth of that revenue increase, and we also saw our second most recent merger, the Tourist Partnership, deliver the difference at just under 200,000 of that revenue as well. If we then move on to our EBITDA bridge, the first block that we see in that increase from 8.3 to 8.9 million is just that point I've just talked about. So it's acquisitions. That those quality businesses that we bring on board to the Mattioli Woods Group have delivered in excess of £700,000 in the 6 months just gone. We also saw EBITDA improve, and we've called it reduced staff cost. But at the start of the pandemic, we took a number of decisive actions very early on, and a major part of that reduced staff cost was around the empathy. Our executives and our senior, some of our senior leaders took pay reductions between 100% reduction through to 50% reductions. Now, in the period, that lasted the whole 6 months, and it only stopped in December. So year on year, we see a significant part of that 1.6 million down to reduced salaries at the senior level. The other element of that was our decision at the end of last year to reduce bonuses for all our staff. That wasn't a decision that we took lightly, but in the period, we have already, on the basis of the proposed dividend, we have reinstated those for staff for this year, not to go back to retro pay for last year, but we've reinstated bonuses for this year. So we see a slight element of saving on that. And then the other feature to talk to on this bridge is reduced overheads. Now, we've always maintained a cost-conscious mentality. We have a saying internally that we have everything that we need and nothing more. And we've adopted that mentality even more so during the pandemic. So naturally, we'll see reductions for things such as reduced travel, as we all are restricted in our homes primarily. But we also have reduced occupancy of our office estate. But as I said earlier, we still chose to invest in training and development of our team to offset some of those savings. As a business, we continue to remain very cash generative. What we saw in the period was a reduction in our cash by some 8 million, but that's having paid two big tranches of money. We paid just under 12 million for acquisitions or for mergers, and they were primarily the Hurley partners, but also some deferred consideration that we had on deals that we did in the last 2 years as well. So we paid just under 12 million. We also paid just over £3.5 million for the year-end dividend. So having paid some 14.5 million, two big one-off payments in the period, we maintain a very high cash conversion level of 86%. Now clearly that is based upon our trading performance and some of the savings that we saw come through. So on a normalised basis, we'd expect that to be in the mid-70s, and that's where we project our numbers to be. And as I said, having stabilised the business on the basis of year-to-date results and where we expect to be for the rest of the year, we are trading in line with performance, and therefore we declare an interim dividend of 7.5 pence, which is progressive and maintains our commitment to a progressive dividend policy. We understand the importance of dividends to shareholders, but as we'll come on to talk to in a second, we don't just look at one group, we look at all of our stakeholders, all of our network. And as we've reinstated bonuses for our staff, at the same time we married it up with an increased dividend to shareholders. I think if we then move on to technology, I think between Ian and I, we'll talk about this. And Ian's already outlined in our strategy the importance of technology for us. I think the key thing to note is that the phrase that Ian said at the start, we're not having to put things right because we've been doing things right for a number of years. Technology is clearly going to be a platform that we're all going to need for the future. And we talk about operational efficiency and winning new clients, and technology will do that for us. But for a number of years, we've invested consistently in our MWeb platform and in all of our systems. Now, we currently have a development team that consists of 12 developers, and we expect to grow that as we build capacity for our future. And we also have a view that where we can build ourselves, we will. But when we need to use other people's technology, then we're also happy to do that, as long as it increases the client proposition. And that is where we expect to go. So not only do we invest, in excess of £2.5 million a year, and we have done for the last 10 years, and we will do for the foreseeable future, we're also looking to invest in a platform. And you'll have seen a recent RNS that we released in relation to our investment in a company called Tiller Technologies. Now, Tiller will provide a new platform to win new clients. It will provide a new platform for us to open ourselves up to a new demographic, and it will also enable us to improve the efficiency with which we relate to all of our existing clients in terms of how we onboard them and how we take them through a risk profile. If I hand to Ian to talk a little bit about Tiller, and then I'll come back and talk about ESG.
Yeah,
Thanks, Robert.
What we are trying to do is build a long-term sustainable platform, and historically that has worked very well for us by seeing our clients face to face, or indeed screen to screen as it is now. But going forward, we just need to further that with technology. And as I've already said, businesses that don't invest in technology solutions or indeed change actually end up dying, and you try not to die as a business. So we've looked around and we said, well, there's this big gap for us. How do we attract people's investments who may not have invested ever before? And indeed, for some of us, and I'm one of them, I use other people's technology solutions to invest, very simplistically, for certain types of investments, like investments for my grandchildren. Now, that's sort of a nutmeg style solution. So on the one hand, we know there's this great big thing out there, simplicity and technology, but how do we take advantage of it, being a relatively small and indeed new in context of some business? And that is to joint venture with a great business called Tiller Technologies. They supply the platform technology, have already got it off the ground, so it's not like we're investing in hope. What they haven't got to date, they don't have distribution. They don't have our 65,000 clients. They don't have our brand and the ability to attract new potential clients into their platform. So a joint venture with us making an investment in Tiller, as well as buying their product, seems the logical way forward. And again, just to reiterate, it is to pick up people who are investing for the first time, typically where families have used deposits in the past to generate interest. Well, we all know there is no interest around, so that those monies need to be considered, but they need to be managed well and risk profiled. And at the other end of the scale, for our existing clients, we all have bits of things that we probably wish we hadn't, and where we want to consolidate. And it's so much easier consolidated into a tech platform. Now, as Ravi has said, our investment in technology will probably never stop. In fact, if it stops, you probably know we're going to tip off a cliff in 2 or 3 years' time. And these, again, Nutmeg, for instance, has spent the best part of 200 million on marketing. We're not going to do that. We can't do it. But what we can do is bring substance to a new concept. I'm personally going to move all my bits. Mike Wright, who's our group managing director, he's going to move his. A lot of our clients have still got the old style monthly savings unit trusts. And that will be a consolidation play for existing clients, as well as attracting new people. And that's really exciting for us. But it's not going to be at the expense of rolling a dice and hoping it comes off, because we still have the core of the business underpinning everything. I'll flip on to the next slide, Robert. Yeah. Asset management. This is key. Historically, when we came to market, we were a specialist advisor and a specialist administrator. We are now an investment manager of substance, managing £3.5 billion worth of assets through our discretionary investments, which is a range of OICs, custodian REIT, which is a real estate investment trust, is key to the way the business as a whole moves forward. But we don't just use our own products. I mean, as a business, we have more invested in other people's REITs than we do our own. And, you know, indeed, for those who have looked at our sort of business profile, we own a business called MATTIOli. And MATTIOli is a joint venture, very similar to the way we've set up Tiller. We own 49% of MATTIOli. And when we started talking to them, they were only managing 80 million. When we did the deal, they were managing 120 million. As of these results, which is end of November, they managed 840 million. A few days ago, when I checked with Paul Jordan, they were managing 950. Now, hardly any of that money, only 50 million, has come from ourselves. So what that means is that other people are supporting and investing through the MATTIOli investment funds. Developing out our talent is really key, you know, and as you can see, there is a difference there on the screen. You've got Chris White, who's probably greyer than I am, just about, and Lauren, who isn't. You know, so we've got that blend again of youth and experience, and we think that's really important going forward. We can all learn so much from each other. Do you want to take that slide, Robert?
I will, absolutely. So ESG, I think it'd be amiss if we did not talk about ESG. But the truth is, ESG has been part of our DNA from day one. It was part of the DNA that Ian and Bob had when they set up the business. So we use the phrase that ESG has been 30 years in the making for us. It's not something new, and you'll have heard that in some of the opening remarks around our view on clients. When we talk about ESG, I think a lot of it is often get held up with the E and not the S and the G. But it's important to recognise all three aspects. Clearly, we will start with E. And whilst we do have a suite of modern offices, we have 11 offices around the country. You know, arguably, when COVID started, that network of 11 offices became 640 offices, because every single one of our team who are working at home became a local MW office. So our reach into our communities, our reach into our client base, it extended overnight. And the other thing to mention on there was when it came to the pandemic, on Friday night, we effectively closed business and everyone went home. On the following Monday, we were instantly 640 offices without any issue, and we're operational from that morning. What we have heard is instances where some big institutions took 2 to 3 weeks to answer the phone. And that's a credit to our investment in IT, but also a credit to the team, where we've been able to go out and maintain that operational efficiency throughout the pandemic to today. We've also reduced significantly the amount of paper we put into the post system. I think the pandemic has accentuated that somewhat. You know, most people, myself included, don't really want to receive post through the letterbox anymore. So as much as we can digitize, as much as we can send electronically, we can do that. And throughout the pandemic, we've reduced the amount of paper by some 500,000 sheets. You know, that's no mean feat, and clearly there's work to do, but we're quite proud of that fact. Ian's just talked about our MATTIOli business, and we've honoured the commitment of Paul Jordan and the team there to donate 10% of their profits to charities. And in the last few months, we do partner with Alzheimer's UK, and we've raised over £300,000 for them, driven by a number of events that largely Simon, our CIO, has led. And they included things like a quiz night with Stephen Fry. But we're very proud of the fact that we're able to support those communities, and not just the big institutions. We also support more than 50 charities in our localities, charities that are relevant for that city and for that team. Within the pandemic, clearly the phrase mental health and well-being has come to the fore. And whilst we did a great amount of work pre-COVID, and we're very proud of our HR team, we must acknowledge the work that they've done throughout the pandemic to focus on all employees who are working at home, who are working at the end of beds, who are working on dining tables with children homeschooling next to them. The work that they've done has been fantastic, and the support we've given to the team at large has been second to none. Ian also said at the start that we chose not to use any government support, nor do we expect to. And as a financial services business, where our main line of work is to be entrusted with the wealth and management of that wealth of our clients, we also have an imperative to manage our own wealth, and we see it as the right, proper and social thing not to be taking any government support when there are businesses out there who are far more needy for that help. If we move on to governance and social, for over 5 years, we've benefited from having a balanced board of an independent board, where we've seen the majority of our PLC board was female. I read yesterday that 30% of FTSE businesses, or 30% of the executives on FTSE businesses are female. We've had more than that. We've had 60% for the last 5 years, and recently we've just increased the diversity, the skill set, and the makeup of our board, such that we have a greater breadth of experience and insight to manage our business throughout the pandemic and way beyond as well. The other feature to look at in terms of our culture is, Ian said at the very start, one of the reasons for floating was to broaden that shareholder base. Today, we have around 20% or just under 20% of our shareholder base is our staff and our team. And then we maintain that focus and that respect. And we have a phrase that clients are at the center of everything we do, and we really do live by that. And then from a sustainability perspective, we do offer attractive client TERs, and we are one of the forward thinkers in terms of where we expect that to go, and we expect client TERs to come down, and we're prepared for that. We have a responsible investment process, and we have some new funds that will launch to the market, including a responsible equity fund under our ESG proposition. So with that, I'm very conscious of time. We'll move on to our acquisition pipeline before we take some questions and sum up.
Yeah, just leave it there for a second. This is a fascinating slide, and it is really important. This shows our future capacity. So this is showing why we are able to grow. And that's because we spent a lot of time in developing bright young things in the world called advisors or consultancy. What we'd like to see with that graph long term is a very healthy number on the left hand side, and an increasing number towards the right hand side. Let's not forget, the average IFA revenues in the UK is a little over a couple of 100,000. So by joining our 5 pillars, and some of the questions that have come through regarding particularly sort of our recurring revenues are all about sort of this long-term sustainability. The 6% of work that we don't do are one-off pieces of business. Once a client is boarded with us, they're signing up to long-term engagement through advice, through administration, and that's why we call it recurring. So the revenue flows are very healthy in good times and indeed bad times, as we're currently seeing, and we're agile enough to flick that into those revenue streams around. The new business figures really speak for themselves. We've done more new business in this half than we did in the last half. And the last half we had no COVID constrictions. So again, it's pleasing to see that our younger consultancy team, the people who are in those first 4 columns, have actually engaged with the new technology and have been able to bring on board new clients. Indeed, it's a win-win for us, because the number of people in the top 2 columns, they've been able to share their clients with the less experienced people, are able to mentor easily, and also be mentored by the youngsters on how to use the technology that we're all having to use. So, you know, these are win-win for us. But if we just move, you know, this business is one of its core activities is we can grow strongly organically because we have and own our distribution, and we have a team of currently 131 people who are advisors who are able to bring in revenues to the group. But we can also bring in, like I've said, experienced people who have become unsettled, and we also can bring in great businesses that want to be part of us. One of the questions was, you know, how are we finding the M&A market? You know, and I always say it's very easy to buy rubbish. We all know that. It's very easy to overpay. We all know that. What we tend to do is we spend a lot of time when we're looking at other businesses on what I would call social diligence. And social diligence is really getting to know and getting under the skin of the people and their culture and their values. Because when you buy somebody, you are going to have a position at some stage in the future where you all need to sit around a table and discuss things. But when you leave the table, you need to be able to be friends. And that's why I think fundamentally, you know, we've done 26 acquisitions and every single one of them has been successful. But, you know, there are some key elements. It's got to be a strong fit, you know, it's got to enhance. You know, so many businesses, they just buy to you know, increase revenues. It's got to enhance, and particularly the client proposition. It's got to enhance our distribution. You know, it's got to be doing some things that we're not currently doing. They've got to integrate. You know, there's no point in us buying businesses which just are left to themselves. There's no point in that. You know, we need to use our MWeb system rather than the systems they're currently using, because we own MWeb. They often rent their systems and their platforms. So there's some sort of savings. The market is fragmented, and you know, those people who have wanted to sell out to the highest bidder, the private equity style, the consolidators, probably already have done so, in fairness. So when we get into negotiations, and our pipeline of acquisitions is as strong as it's ever been, and you know, one of the questions we've been asked, you know, do we have enough money to fund all of those ourselves? The answer is yes at the moment, probably not in the future. Our acquisitions tend to fall into three constituent sizes. We have small ones, 1 or 2 advisors. We have larger ones where there might be a dozen or so fee generators. And then there's the big ones, which might be sort of administration driven or investment driven, so might not have any advisors, but create revenues and profits. And all of those would be acceptable as we grow and develop into our big, hairy, audacious goals. Often I hear acquisitions from other CEOs is their cake. It's not our, you know, it's not our cake. It's, you know, it's a bit of icing, but it's part of how we're going to grow and develop the business. And we can do that organically. We can do it by bringing in experienced people, and we can do it by growing through acquisition. So just turning on to this final page, you know, why are we proud that, you know, we are an investment proposition, particularly for long-term sort of shareholders who are wanting to see something grow and develop well. And I think that sort of boils down to our roots. You know, it's looking after the Keith and Barbaras again. You know, we've acted well, I believe, during the pandemic. We have chosen, you know, not to increase our fees to those clients, some of which, you know, are you know, part of the fee agreement that we can increase our fees, but we chose not to. Yes, that's affected our revenues, but we feel that's right and proper given the adverse circumstances that we find ourselves in. You know, everybody knows somebody who has been made unemployed, who is furloughed, or whose businesses have fallen off a cliff during this thing. And I don't want to add to those people's woes. The business doesn't want to add to those woes. So let's be empathetic, let's be sympathetic, but let's carry on building our strategy. Let's build our capacity. Let's continue to train and develop our consultants so that they can go out and win new clients. And when you put all of that together, you know, it's being competitive, it's being agile. And, you know, the mantra is always the same. If you look after clients, they will look after you. And that's how we've built our business. That's what we've spent the last 30 years in doing. And that's what we will continue to do for the next 30 years. Our business is good for clients, but it's also good for shareholders. It's also good for our employees. And finally, and this is often a band of people who are often forgetting, it's good for our suppliers, the people who we buy things from ourselves, because we see all of those four as a partnership. You know, we have a phrase, our people, and that's what it means. You know, it's not one-sided for any particular area, and we work through all of that as a conscientious, socially responsible business. So I don't know, I think we may have actually answered all of the questions. So if anybody else has got any quick questions, I know we've sadly overrun by 6 minutes.
No, I think Ian, Ravi, firstly, thank you very much indeed for that presentation. And as you say, you have answered pretty much all the questions that we've had come through during the event, either during the presentation or through the event. So thank you very much. Ladies and gentlemen, do please continue to submit your questions just using the Q&A tab situated on the right-hand corner of the screen. If you could just send them through. If there are any further questions that the company can answer, they can either review them or answer them now. But lastly, perhaps before I hand back to the team, if I could perhaps ask Ian if you do have any final words, just in case we have any final questions that come through. If not, we will redirect investors to give you some feedback.
That's great. I mean, we've really enjoyed talking to everybody. Still seems strange that we can't see faces, but I hope you've all enjoyed that. You know, the business comes from our heart, and, you know, long may that continue.
That's fantastic. Thank you again, Ian. Thank you, Ravi.
Yeah, I think, Paul, we just had one quick question come through around platform investment. Yeah, so the question relates to is all of that, is all the investment in the platform going to be expensed, or effectively is that going to be capitalized? Historically, where we can and where it's development, we would look to capitalize that spend. As we talked about earlier, MWeb is our core platform that we are building upon, and would expect to capitalize between 75 and 80% of the spend in development to MWeb or the relevant system that we are developing. Clearly, where it's a license or where we've acquired an off-the-shelf technology, then that will be a license fee that's expensed. But where it comes down to in-house development, absolutely, we will capitalize that and put it through depreciation rather than OPEX.
Perfect, Ravi, thank you very much. And as I say, thank you for answering those questions as we've gone through the presentation. Ian, Ravi, thank you very much for updating investors today. Could I ask investors not to close the session, as you will be automatically redirected for the opportunity to provide your feedback. If you've accessed the meeting from our website, the feedback page will appear in front of you. If you've accessed via the link sent in the email, you'll be asked to log in and submit your feedback. It only takes a few seconds and it's greatly appreciated by the company. On behalf of Mattioli Woods, an Investor Meet company, I'd like to thank you very much for attending today's presentation. That concludes today's event, and good afternoon. Thank you all.